And the more volatility that you have in your financial plan, meaning like the more exposure you have to things like the stock market, the more flexible that you want to be as you progress through that plan. So like, for example, whether that flexibility looks like spending or we talked about Roth conversions, like if your advisor says, hey, this is what we're going to do prescriptively and, completely independent of the market, we're not going to change a thing. I don't know if I see that as the right way to go. I think that there are, for at least for clients that we have, when markets go down, we may make some tweaks to kind of the planned, expenses or planned goals, whatever it may be. But we may have conversations about, hey, what kind of adjustments do we make? Now, if that client isn't very aggressive and their, portfolio is not moving around, then maybe we don't need to have those conversations. And I'm not saying those conversations always are lifestyle adjustments. They can be things like, hey, we've been working on paying down some debt. And while the market's going up, we've been making regular payments on that. But hey, while the market's down, let's put that on pause for the moment. And let's kind of hold off until the market comes back again, right? There's lots of things that you can do to kind of reduce the selling pressure on your portfolio in a period of stress.
Check. Yeah, that's better. Like, can you talk now?
All right, I'm talking.
Can you hear yourself?
I can hear myself.
Okay, very good.
It's fantastic.
I too am extraordinarily humble.
This is not the podcast yet, I guess.
No.
I don't know. Well, welcome to the Money Alchemist podcast. I'm one of your hosts, Brent Gargano.
And I'm Ben Jones.
And we're here today to talk a little bit about market volatility.
Yeah, I wonder why.
I know we try to set these podcasts up so that they're not too time sensitive. You can come back and listen to them. But for anybody listening, this August has not been too friendly for markets.
No, in fact, the VIX spiked to records not seen since the great financial crisis. So we've actually only seen the VIX spike above 60 in the past 30 years, at least, since they really started the index on two separate occasions. One was 2020, which we all know what was going on then with the lockdowns, and the other was the great financial crisis. So, we saw this massive uptick in trading volatility, which usually indicates not all is well in the financial plumbing.
It doesn't make people feel good to wake up to the kind of messages. Everybody's getting those push messages.
And the average person, I imagine, they just go to work and, on their way home, they're listening to the radio or maybe one of their coworkers pulls them aside and says, "Oh man, have you seen the market? It's going crazy." And all they do is they see red screens. Have you seen the meme with this template's used a lot? It's from Seinfeld, when Jerry knocks on Kramer's door, and then Kramer opens it and it's all red. And it's like, "Jerry, what's going on in there, Kramer?" Well, I've seen that meme used so much on, different socials where, Kramer's like, "It's the yen carry trades, Jerry. It's the yen carry trade. It's unwinding."
Well, and for the listeners out there, I mean, the yen carry trade was really the triggering event for the worst day that we had seen in 2 years last Monday. So Ben, are you able to explain that a little bit?
Yeah, a little bit. I'm not going to go too much into the details because I'll probably get something wrong. I don't personally participate in this trade, but I understand the mechanics of it, and it's fairly simple. So the Bank of Japan, who invented quantitative easing, which is a fancy word that we've all grown accustomed to hearing, and we all abbreviate it QE, and we just assume we know what it is. And it's always been a thing. It's like, no, actually, Bank of Japan invented that. And it's a way for central banks to depress yields. So what they do is they will simply print money, in this case, yen, and they will take that money and they will use it to buy bonds off the balance sheets of banks. And it increases artificially demand for bonds. And since bond demand and interest rates work inversely, that effect has a depressing rate on bonds. So yields come down.
So put a different way, basically the Bank of Japan artificially makes sure that the interest rates stay low.
Yes. And all central banks do this. It's one of the tools in their arsenal against, deflation or economic stagflation or whatever you want to call it. But the Bank of Japan,
if the price of things is constantly rising, the economy by default is growing.
Yeah. So the Bank of Japan has a unique environment because Japan suffers from chronic low inflation rates because of population issues. I'm not going to get into all of that, but and on top of that, Japan structurally is a net export country. So they have spent decades, building Toyotas and Mitsubishis and you name it, and sending it out to the world, mostly the US. In exchange, we've sent them our money. So they had to have a place to put all this money. Well, they put it in their national treasury. So they've got a huge war chest to combat, yen weakness. So, and this is important as germane to the story here. It's important to note that the Bank of Japan has huge amounts of essentially U.S. treasuries.
Essentially, they have a lot of dollars.
Correct.
So if the yen, if their own currency has an issue relative to dollars, they've got
they basically could just dump treasuries on the open market and trade the dollars for yen and strengthen the yen. Right. And they do that from time to time. Anyway, but let's get back to the point I'm trying to make, which is the Bank of Japan has artificially depressed interest rates to the point where you can get a long-term Japanese bond. And it's only going to yield something like less than 0.5%. It's very low. Compare that to the U.S. treasuries yielding around 4.8% last I checked. Of course, they've come down since because of this whole yen carry trade unwinding. But so what the intelligent financial gurus would do, these brilliant people on Wall Street that know things that we don't know, and they know how to manage money, and we're just a bunch of plebs. So what they do is they go and borrow Japanese yen, which, mind you, that's a weakening currency relative to the dollar. All right. So they borrow Japanese yen. They do this mostly by just shorting Japanese bonds, government bonds. And they take that yen, the proceeds from that sale, and then they go invest it in, U.S. treasuries or U.S. stock markets, something that's, appreciating. And it's just free money. Right. What's there not to like? So you're getting the benefit of the currency appreciation. There's a currency arbitrage there, but you're also getting a yield differential there.
Yeah. So to try to distill this down a little bit, taking the currency effect out of it, this is essentially like being able to go to one bank and borrow a bunch of money and pay very little to nothing on that money, and then take that same money and go put it in something else that pays you 5x that. So think about this. If you had $1 million and you could borrow $1 million at 1% interest and go reinvest it at 5% interest, you're just pocketing $40,000 a year.
Yeah. And in this case, the entity you're borrowing from, for all intents and purposes, is the Bank of Japan. So you've got this situation where you incentivize a lot of leverage. You can imagine people love free money. Institutions love free money. So, but the Bank of Japan knows this is going on. So they're always walking a tightrope, and they send signals to the market. And remember that arsenal they have, that war chest of treasuries, where they can just dump these U.S. treasuries in the market to defend the yen. And they can also decide, well, we're going to increase rates. Central bank, the head of the Japanese central bank, I forget his first name, but his last name is Yuda, decided, well, we're just going to increase rates by 15 basis points, which sounds to us like nothing. Right. But when you have that amount of leverage in the system, that Wall Street Journal, which we put in the show notes, the article, nobody knows how much the yen carry trade is. I've seen estimates going all the way to $20 trillion, which is a bit absurd. Billion. No, trillion. I've heard estimates of $20 trillion, which is absurd. It's absurd. But the actual amount is probably closer, according to the Wall Street Journal, about 2 trillion, which is still a lot of money. But keep in mind, not all that money's at risk. So you're really only at risk in the margins. But what the Bank of Japan did is they increased the rate by 15 basis points. Mind you, they just announced they're going to increase the rate. They haven't actually increased the rate. In fact, since the Bank of Japan has come back and said, oh, we're just kidding. We're not doing that anymore. But it's not the rate increase that matters. It's the signal. It's them saying, okay, we are going to defend the yen. We're not going to let the yen depreciate against the dollar anymore, which that's a huge component of the carry trade. So,
so again, to slow it down, going back to my basic example, if you could borrow at 1% and lend at 5%, that sounds all great. But then you introduce additional risks like, okay, well, I'm borrowing at 1% and then I'm lending at 5%, but I'm borrowing in one currency and I'm lending in another currency. And those two currencies change value relative to each other, which can be a good thing or it can be a bad thing. In this case, the signal is that's going to be a bad thing.
Yeah, it's going to be a bad thing for those who are too far out over their skis on this particular trade. Now, most of these institutions are not taking these risks ignorantly. So they do have a way to unwind these trades. And it's not like these rates are changing so drastically that automatically they're all losing money. It's not a liquidity crisis. This is not a liquidity issue. In fact, liquidity in the markets has been quite good, as these trades have unwound. But anytime you make a structural shift like that, it's going to introduce volatility that didn't exist before. And these positions all have to get unwound. So stocks have to be sold. U.S. Treasuries have to be sold. Now, interestingly, because the size of the trade was, this is what indicates to me that the size of the trade isn't what's pushing markets into this record level of volatility. It's the reaction to the trade. So it's all the second and third order effects of this thing. Because these institutions that are unwinding these positions, most of them are in U.S. Treasuries. So they're selling U.S. Treasuries. Yet U.S. Treasuries the yields have come down quite a bit.
And generally, when you sell bonds,
the yields go up. So
because they need to be more attractive, right?
Yes. So what that signals to me is that the global marketplace is in giant freakout mode, and they're saying, "Sell everything, buy treasuries."
Yeah.
And interestingly, it's allowing the banks a fruitful exit because they're now selling these bonds at even higher values. So they're actually unwinding these trades probably a pretty healthy profit. So I think this whole thing is really going to blow over. In other words, I don't think it's going to amount to a bear market. There's folks out there thinking, oh my God, it's the end of all things. And the yen carry trade is over. Japan is over. Everybody was saying Japan's over. Now, I will say Japan they are forever going to be walking this tightrope because they have so much debt to GDP. There's no way out of it. They have to depreciate the yen. And they've got these population. Japan, the conversation in Japan is probably a whole nother podcast.
When you say they have to depreciate the yen, they have to print more money.
Correct.
To manage to keep their debt.
Yeah, because otherwise they
control.
don't have enough economic productivity. Their population isn't high enough to grow into the problem. So they have to deflate the yen. So Japan is on this it's a controlled demolition. I don't know how they get out of this, but in the meantime,
essentially, it kind of relates to the U.S. because we always talk about how much debt the U.S. has. Mm-hmm. Once you're in a position where you have so much debt, there's only 3 ways to get out of it. You can either raise taxes, raise revenue. Mm-hmm. You can grow, which in effect raises taxes, or you can print money to pay off the debt, which looks okay at face value, except for the fact that now you have more money, mm-hmm. so your money is worth less, thus inflation.
Yeah. That's exactly right. Now, it's funny. People act like they don't know where inflation comes from. I watched a video from Milton Friedman just over the weekend, and he summarized inflation in a very eloquent way. He was at the U.S. printing press at that time when most transactions were done in cash. And he said, this is where inflation comes from. That was pretty much it.
Fairly simple.
Yeah. It's like, okay. Yeah. It took like a minute and a half to explain the whole thing. And yeah, I mean, the cause of inflation is just literally there's too many dollars or too much of any currency chasing too few goods. So anytime you just arbitrarily increase the amount of currency in the system, you're going to get inflation. In fact, if you look at M2 supply relative to our inflation numbers, it peaked right at the same time inflation peaked. And then since M2 is declining, and so while we've had slowing inflation, it's because M2 is declining. It's really not that complicated. I think people...
And M2 is the supply of money in the system at any given time.
Yes, it's a supply of essentially U.S. savings. So think your savings, checking, things like that. So it's not like institutional money. I think that's, what is that, M1? Anyway, we're not going to get into all that. But back to the yen carry trade. So this thing is still unwinding. I've been following the various X feeds that follow this trade very closely, and a lot of them work on the trade. A lot of the people commenting work on the trade desks, and one of the big banks that participates in this is, of course, none other than J.P. Morgan, and they've stated that the yen carry trade is about 2/3 unwound already. So we're pretty close to the end of it, but this wasn't the only thing I fear that sparked the sell-off, because if you recall, it was like a couple days prior to this whole, the Japanese bank announcing the interest rate hike, we had a weaker than expected jobs report. So, and that kind of had a lot of people scratching their heads thinking, okay, well, what's the Fed's next move? And everybody seemed to conclude, and they're still concluding this, I think, what is that? FedWatch, the FedWatch tool is predicting 100% likelihood of a Fed cut in the September meeting, which I don't like predicting anything in the future with 100% certainty. But that's what markets are saying. They're saying, well, we're going to cut because of the jobs report. And I think there's been also some there's been the PMI came out and it's in contraction mode. So I think the reading was 48.5. Interestingly, global PMI is actually in expansionary territory because of India. So India's economy is doing quite well. But this week,
the U.S. is pretty clearly starting to show, like a few months back, people started thinking about, okay, maybe the consumer is weakening. We started to get earnings out of companies like, Target and, some of these major retailers that were saying, hey, the consumer's starting to feel a little stretched here. And so we saw some of the wind come out of the sales of more consumer oriented stocks. That was kind of combated by this thinking, well, the labor market's holding up really well. And now we're starting to see the labor market show some signs of weakening. And so this is kind of a good and I don't know if it's good and bad news. The bad news is, like, fundamentally the economy is slowing. Now, that doesn't mean it's, getting worse. That just means it's getting better less quickly, right? The other side of that is, well, the Fed has rates at almost 5.5%. That's the equivalent to me of having a revolver with all of the chambers loaded, going into a fight. And so, back to your comment about September cuts at 100%, what's the likelihood? I mean, there's at some points there have been actually chances of over 100% of a 25 basis point cut, which tells you that the market's starting to price even bigger cuts, right? The Fed could come out and instead of dropping rates by 1/4 of a point, they could drop rates by 1/2 of a point.
The expectation right now is that in a year and 12 months, the Fed will be at 3.25%,
which is more than 2%. Below where we are now.
Yeah. And keep in mind, markets are consistently wrong about this. The Fed is consistently wrong about this. I think it's hilarious to me that we all try to predict this future with such precision. It's just never.
It's totally unknowable.
It's completely unknowable. All we look at, I'm looking at the economic release calendar here, and we've got a busy week. So, we've got the PPI final demand data coming out. That's what the Fed really looks at. So they track inflation looking at PPI. And then we also have CPI coming out on Wednesday. Then on Thursday is going to be a banger. We've got jobless claims, retail sales, Philadelphia Fed manufacturing, and then housing starts on Friday. So jam-packed week in the economic calendar.
Well,
I think
when are the Nvidia earnings?
Well, that I don't know. Maybe you can look that up. But I don't really follow Nvidia stock as closely as I should. So yeah, but that would be interesting to see. Not to get too much off on a tangent here, but I've been hearing
August 28th is when Nvidia releases earnings.
I bet their earnings are quite good. However, I've been hearing inklings that their chips have gotten too expensive and there are alternatives. Like I've heard that Apple said they weren't going to use Nvidia chips to run their AI. Did you hear this? This is a rumor. I don't know if it's true or not, but I've always speculated that Nvidia is too expensive because the competitors aren't going to let them eat the entire lunch.
Sure.
They're going to come in.
They're the first to market.
Yeah.
But, I mean, you can't have profit, amazing profit margins and things like that and not introduce competition.
Let's get back on the topic, though, because I don't want to speculate
the only reason
on
I bring it up is because I think Nvidia earnings are going to be a big market event.
Oh, yeah, because it's one of the top 3 companies. I know it's not the top
and
anymore.
It's the poster child for AI. And there's a lot of, for somebody listening to this podcast, you've watched how the stock market's gone up in the last couple of years. And it does feel like there's a lot of hype, right? Between AI and, the money that's gotten pumped into the system and the Fed, the way that they've got rates set up. And, there are a lot of risks, right? And you think about what happens if AI stumbles. Are we overhyped on AI in the short term? You think about presidential election, and we've talked about the impact of elections on markets over the long term. But there's no question that, it could introduce volatility in the short term, right? So for the average listener, I think Nvidia earnings, really signal for a big part of what's been driven the stock market up. Kind of where's that directionally going? So I think Nvidia earnings are going to matter. Now that's the week after, like next week, I think.
So it's like the canary in the coal mine as it pertains to artificial intelligence.
Totally.
Yeah.
And I think there's a lot of the market that's done well on artificial intelligence. You can see that in the dispersion between the average stock and the biggest companies in the S&P and all these things that we've talked about in the past. So
yeah, I think all these things are weighing on markets. One of the themes that I'm seeing out there, it's not, theme is probably too strong. It's more like whispers, whispers in dark corners, and that is that AI is, we've priced too much in too soon. It kind of like we saw in the .com bubble. Now, I'm not saying this is a bubble, but this is what happened in the .com bubble. The internet was going to solve all these things and it was going to be fantastic. We're going to remember back during that day, we thought everything's going to be bought online. Things are going to be shipped right to your home. And it sounded like fantasy because that's not the way it worked. And in 1998, you went to Walmart and you bought the good and you brought it home. There was no going online and ordering things. That's that was niche. If you did that and you paid out the nose and shipping costs, nobody saw the sense in it. But all these analysts were like, that's the future. That's where it's going. So the market said, you're right. And it rallied. Cisco stock went through the moon because that was going to be the thing that runs all these internet servers or whatever that Cisco does. I'm not a techie, so I don't know. But, fast forward, the bubble collapsed. But everything they said was going to happen eventually did happen, and it came true. And then the market resurged. Now, granted, we had a great financial crisis that kind of interrupted that, plus the wars, the terror wars. Anyway, so that got interrupted and delayed the process. But ultimately, the growth was there. But it just got a little ahead of itself. And I think that the same thing could potentially be happening with AI. So you might see a reprieve in the rally. And I think I wouldn't be surprised. Now, this is not a prediction, but I wouldn't be surprised if NVIDIA's earnings, if not this August, but in the coming months, came in a little bit weaker than expected because of the nature of expectations getting bigger. Yeah,
sure.
And from what I've been told by people, I've been told this by several people that work with AI. They're developers, they sell the AI systems, and that is these things are just not where they need to be in order for them to be considered a final finished product. They give wrong answers too often. And they're difficult to set up because of data sets. What we're dealing with here, and this is way off the topic, so let's get back on the board. But what we're dealing with here is a data organization issue, and it takes a longer time to resolve that. So it's more than just buy the NVIDIA chip, plug it in, tell some dude named Ben, who's a computer coder, to put it all together, and then just send it out to the consumers and watch them just go mad over it. It's not that simple. It takes a lot longer to develop these things, and I think the market is priced in. And I believe that will probably take less time for it to be worked out. Probably another 2 years, I'd say, before we're really seeing the benefits of AI. Anyway,
but there's likely to be, whether it be, an unwind of a currency carry trade that you're just learning about, that's, reducing, removing leverage and taking the stock market down, or whether it be NVIDIA having a falter in earnings and that taking some wind out of the market, or whether it be joblessness, becoming more rampant and the Fed, talking about potential recession. I mean, there's plenty of things that can push the market lower. I think what's important from our perspective for our clients as advisors is to recognize that just because the market goes down doesn't mean you shouldn't be invested over the long term. The downs are a lot less permanent and a lot less meaningful than the ups. I have a stat here, and we've got this listed in the show notes, but if you look historically at the market's ups versus the downs, the average market increase is like 140, here I have the number here, 149.2%. And that takes a little over 4 years, again, on average. The downturns, and this is the bear market, so this doesn't include the 10% sell-offs like we kind of saw this week. This is, I think bear markets are defined as 20% or more.
Correct.
So the average bear market lasts 11 months, so a little less than a year, and has a loss of about 30%. So the ups are on average 100, and using rounded numbers, 150%, and the downs are 30. So I thought it was funny. I saw a meme with the market burning down last week of, Pablo Escobar going out into the fields, and kind of surveying the carnage that he's created and seeing it as opportunity. Last week, there's big headlines about Warren Buffett. Mm-hmm. Warren Buffett sold a lot of his Apple. He sold a lot of Bank of America. He's raised, I think it's like $220 billion of cash.
I think $275 billion from what I've heard. And treasuries.
It's a lot of cash, right? And
more than the Fed.
so I think it's really tempting to look at that and go, wow, Warren Buffett's done a really great job. And I'm not saying that he hasn't, but
by the way, that's Warren Buffett's Berkshire Hathaway, not Warren Buffett personally.
Correct. Yeah. Mm-hmm. Berkshire Hathaway is holding all of that cash. But if you actually look at the market and where the prices sit today versus the last year, you only have to go back like 3 months to find lower prices. I mean, for the average investor, what's really important to be aware of here is that sitting on cash and waiting for the market to burn down so that you can, feel really good about walking in with all this, this cash that hasn't lost value and buy stocks at depressed prices. It's still hard to do that and come out on top. Even in this situation, if you've been sitting around going, gosh, this market's way overvalued and we're certainly, we're going to get one of these days, right? You're going to see what has come into you. If you said that any earlier than, March this year, you're still, you still haven't seen any cheaper prices. And so I think the better way to play these kinds of situations for most, people trying to productively manage their wealth is to stay invested through these periods of times and the way that I talk about it with my clients is we look at, kind of what are the things that are in the up market playbook? Like, what are we going to do when markets are doing well versus what's the down market playbook look like? And I'll say that for my clients over the last couple of weeks, we've started to talk about some of the down market playbook concepts. So, things like Roth conversions, tax loss harvesting, tax gain harvesting. I mean, if you're sitting on a portfolio where there are positions that have capital gains and you want to get out of those positions for one reason or another, you can sell those positions for less, with less of a gain, and have a lower tax cost getting out of them. Deploying cash, if you do have it, right? It's a great moment to talk about dollar cost averaging. I mean, the list goes on, but it's very different maybe than the list when markets are up. And I say that because I think a lot of people that are fully invested kind of think, okay, the market's down, what do I do, right? I don't have a bunch of cash to buy the stock market with. So what can I do to take advantage of a down market?
Well, yeah, Roth conversions are a great way to do that. You just got to make sure, though, that it's appropriate for you, because just because your account's down doesn't necessarily mean a Roth conversion's a no-brainer. So a definite thing you should be doing is harvesting losses. So if you're investing in a non-qualified account, it's just not an IRA, and these positions are at a loss, then you can easily just sell the position and buy something else. You got to be careful of wash sale rules. Make sure you're not violating those and negating the benefit of harvesting the loss. But these are good things. Now, I think most people like you and I, for example, that are in growth mode and savings mode, I generally don't have a problem convincing them to stay invested, because it's the easy thing to do. People are like water. They go the path of least resistance. So the easy thing for them to do is generally nothing.
Do nothing.
So they just ignore it. Now, occasionally I've got people that'll come like, I got to time it. I've got to, get out of the markets. But it's out of the thousands of households we manage, it's a fraction. So most people generally don't, that are in growth mode, that is, don't freak out. It's easy to say stay invested for those people. Where it's difficult is, I'm retired. This is all I got. I don't want to see my net worth fall by 30%, because if it falls by 30%, how do Brent, guarantee me that it's going to recover? You can't look at them straight face and guarantee it may not. You don't know, but we have a lot of confidence it will. It will just say this: if it doesn't recover, it'll be the first time ever it's not recovered. But still, while you're waiting, there's that anxiety that associated with your final years of your life, your golden years, you really just don't want to have. You want to not be concerned about the stock market, something you have literally no control over, sinking your quality of life. Retirees don't want that. So I think we need to send out another message, not just hold your investments. It's so easy. It's easy for you because you're working and you got income coming in. But I could tell you, I got a lot of clients that are retired that depend on their portfolio. They don't have the time to recover from a 30% loss. So what you need to do is make sure that your portfolio doesn't sustain a 30% loss in markets like 08, 09. So asset allocation is very important. Buying the S&P 500 and calling it a day is not going to work. You need to be aware of sequence of return risk. And I think that now is a good time. The S&P, just to give you an idea. So a pullback in the market happens every year. I don't think there's ever been a year where a pullback hasn't happened. That's a sell-off from a 5% or more. Corrections happen generally, I think it was like 4 out of 6 years. So most of the time corrections happen. That's a pullback of 10% or more. So what we saw across the board.
4 out of 6 is 2 out of 3, by the way.
Oh, yeah. Well, okay. Maybe I'm wrong then. Okay. Don't quote me on that stuff. All right.
The point is it's common. Very common.
Yes.
For like a 10% drawdown in the market.
Yes.
Is pretty normal.
The S&P did not even get into correction mode. So it from peak to the lowest point was down 8.5%. Since then, it's come off. It's recovered about 3.5%. So it's only down like 5.2%. The NASDAQ did hit correction. So from peak to trough, it was down 12.3. Since then, it's come up of almost 4%. So it's back out of correction territory. The Russell 2000, so these are like small mid cap stocks, down 10%, but it's come up to 2.4% since then. So what we're looking at here across the board is, if you've got a diversified portfolio, meaning of all equities, meaning you're not just in the S&P, but you're in a variety of things, you're probably down from the peak about, I'd say 6 to 7%. So it's not fantastic. No one's writing to their moms proud about that return, but it is still not so bad where you shouldn't, if you're a retiree and you have all your money in stocks and you're worried about risk and you're worried about running out of money, now's a good time to revisit that portfolio. I think you should probably take some risk off the table because volatility is not going to go away. We are showing signs of a peak economic cycle. Now, that does not mean a recession is imminent. A recession will eventually happen. I predict personally that if the TCJA sunsets, for example, as it's scheduled to do, that's the Tax Cuts and Jobs Act that broadly decreased taxes across the board for everyone in 2017. That's scheduled to sunset in 2026. I think if that happens, that's enough to trigger a potential recession. However, I digress. I don't know when the next recession is going to happen. Nobody does, but I know it will happen. And retirees that are dependent on their portfolio for income need to plan for that. So, there are a variety of tools you can use to de-risk your portfolio. I would say just consult with your financial planner to discuss that. I don't want to get into what tools those could be, but I mean, it's just use of anything that's not correlated to stocks. So bonds, I mean, you could use, puts, for example. There's these things called leaps that.
But in general, simply put, bonds are loans. So you're set to get the money back so long as the company you're lending the money to doesn't go under. They have a fixed rate of interest tied to them. And today those fixed rates of return or those rates of return are pretty good. So, taking a sleeve of your portfolio, and even if you really love to be aggressive, you've been, stocks are how you've made your money and you're now retired and you've got some significant wealth because you've been invested in stocks, set aside a year or 2 years worth of money just to be safe.
I generally say 3 years because looking in the past 30 years at the variety of stock markets that we've had, there's really not a period a diversified portfolio was negative on a 3-year rolling average. So now that's if you have the proper asset allocation. So I'm being grossly generic here. But I think that if you have 3 years worth of cash reserve, and you would want to have this in some sort of asset that's negatively correlated or not, at least non-correlated to equities.
Meaning that if the stock market doesn't drop, you don't want this thing.
It's dry powder. Yeah. So you're not, then what you're trying to do here.
There's not a lot of stuff, by the way, that's not correlated to stocks in some way without going to cash.
Well, you've got investment grade bonds, and then you can also,
even bonds are, other than treasuries, even corporate bonds are positively correlated to the stock market.
Yes.
The point is,
you just don't want to sell losses.
Without getting into here's how much you should have. It's important to recognize that, stock market will do well over time. It's history has shown us that to be true. There's a lot of people out there that have built a lot of wealth by being and staying invested in the stock market. But the key word is staying invested in the stock market. And when you're retired and you're taking money out, inherently, you are not staying invested in the stock market. You are constantly liquidating stocks. Now, you don't want to do that too quickly because over time, it's actually not good for your wealth to sell stocks too fast. But you need to give yourself a level of protection because if the stock market does have a major meltdown, you're still going to have to take money out of it.
You need a buffer. And the reason for that buffer, let's get to the core of the issue. The core of the issue is if the stock market goes down. Now, keep in mind, whether you're buying the S&P 500, like an ETF, or you're buying individual equities, you are buying shares. These shares fluctuate in price, but the share quantity is fixed. So the shares that you're buying. So let's say the market goes down and compresses. You have to sell more shares to sustain your fixed level of income that you need. So that means there will be less shares of whatever you own, whether it be, S&P 500 ETF or shares of some equity that you have. There'll be less shares of that position to recover in the economic recovery.
Yeah.
Yeah. So that's really what it comes down to. You just want to maintain your share quantity. And the way to do that is to have that buffer, have that dry powder. Again, talk with your financial planner about what that is and what that means for you and how much you should have in it, because it's different for everybody. I say generally 3 years, but for an individual that's only drawing a small fraction of their portfolio, it could be less, could be more. But yeah, anyway.
And the more volatility that you have in your financial plan, meaning like the more exposure you have to things like the stock market, the more flexible that you want to be as you progress through that plan. So like, for example, whether that flexibility looks like spending or we talked about Roth conversions. Like if your advisor says, hey, this is what we're going to do prescriptively and, completely independent of the market, we're not going to change a thing. I don't know if I see that as the right way to go. I think that there are, for at least for clients that we have, when markets go down, we may make some tweaks to kind of the planned, expenses or planned goals, whatever it may be. But we may have conversations about, hey, what kind of adjustments do we make? Now, if that client isn't very aggressive and their, portfolio's not moving around, then maybe we don't need to have those conversations. And I'm not saying those conversations always are lifestyle adjustments. They can be things like, hey, we've been working on paying down some debt. And while the market's going up, we've been making regular payments on that. But hey, while the market's down, let's put that on pause for the moment. And let's kind of hold off until the market comes back again, right? Mm-hmm. There's lots of things that you can do to kind of reduce the selling pressure on your portfolio in a period of stress.
Yeah. So being more flexible with your spending, especially in retirement, definitely helps your portfolio mitigate some of these sequence of return risks where really you just don't want to sell on the dips. Buy the dips, don't sell the dips.
And buying can look, like a lot of different stuff. It doesn't always look like directly buying shares. Like we mentioned, the Roth conversion. Roth conversion is where you take a portion of your pre-tax retirement assets, move them to Roth, which are after-tax assets, which then grow tax-free. But to do that, you have to pay the taxes. So you should be working with your advisor to figure out, is it a good deal to pay the taxes this year for my personal tax rate?
Especially right now with markets dipped, but they haven't dipped, as I've illustrated before, they haven't dipped all that meaningfully.
Right.
But you should always be assessing that. Now, I did want to touch on another thing, which is also difficult for savers. It's easy for them to leave their portfolios alone because it's the path of least resistance, as I said. But for someone who's sitting on a boatload of cash, which maybe not a boatload, maybe just a little bit, and they're wondering, okay, when should I invest? Should I invest now? Should I wait for markets to go down further? When should I do it? And I think that the less thought you put into it, the better. I have it. I think people are subject to analysis paralysis, where they will sit on cash for years and years and years, waiting for that inevitable market dip. At least it's inevitable in their eyes, and that market dip never happens. And so if you're wondering, should you be buying into this market? What I would say is just put your investing on autopilot. Always be buying, regardless of the market condition. Don't try to time it. We don't know where it's going to go. It could go any direction this week. We've got all these economic calendar releases. Sometimes the jobs report will come out. You ever heard the term, the bad news was so bad that it was good? Where it's like, oh, the bad news is terrible. That means the Fed's going to cut and the market rallies. It's like, well, that doesn't make sense. Things are bad because the market reacts irrationally. In any given day, acts rationally. Here's an interesting thing, and I don't know why this is. It acts rationally over long periods of time, but irrationally in short periods of time. I don't know what that says about us as humans, but that's something that I've observed to be very true. Anyway, I
think the phrase is, in the short term, the market's a voting machine, and in the long term, it's a weighing machine, is the way that I've heard it framed.
That's a good way. I like that. Yeah. Well, that's a great way to end this conversation. So I think we've covered the topic thoroughly. Appreciate those of you who've listened all the way to the end for staying with us, and we hope that you tune in next time.
Yeah, and if you need any of our information, our contact info, websites, things like that will all be in the show notes.
Yeah, if you don't have a financial planner, give us a call. We'll be happy to work with you. Thanks, Brent. Securities offered through LPL Financial, member FINRA, SIPC. Advisory services offered through National Wealth Management Group, LLC, a registered investment advisor and separate entity from LPL Financial, LLC. The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. Economic forecasts set forth may not develop as predicted, and there can be no guarantee that strategies promoted will be successful. This information is not intended as authoritative guidance or tax or legal advice. You should consult with your attorney or tax advisor for guidance on your specific situation. Brent Gargano is not affiliated with LPL Financial.